is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapscott here with your co-host Andrew Young. Andrew, your hair is looking very luscious today for those watching on video. I know this is going to be a hot episode because you got a haircut in an hour, so we got to jump right into it. So let's start with another big price prediction from Arthur Hayes. Basically, in a recent piece, he said that Bitcoin is going to hit $1 million per coin. So for context, Bitcoin's around $40,000. So that's quite a nice return to target based on where the market is at. And he listed some interesting reasons for that. And Arthur Hayes has now made kind of waves twice in the last few months with a price prediction. Most price predictions generally people tend to discount, but this is a guy who's built like one of the most successful companies in crypto and one of the biggest derivatives exchanges. So I think it's one of those things where Arthur Hayes speaks, you got to listen. So how does he get to $1 million? Let's start there.
Yeah, and also, first of all, Arthur used to be on the trading desk of a couple different global banks. He's a very sort of skilled economics type person, and he wrote another sort of probably 10,000 word or maybe a little bit less essay on this particular topic. We obviously covered the $10,000 by the end of the year ETH call, which was actually quite surprising because historically he's been more of a Bitcoin bull. But so his thesis for BTC hitting $1 million by 2030 is that essentially the what he calls like this inflection point just happened in the recent sort of Russia-Ukraine conflict when the EU and the US unilaterally seized the Russian reserves, which I believe was about $300 billion. And just sort of essentially froze those assets. And the reason why he's sort of pointing towards $1 million is he thinks that countries that are in sort of a not hostile, but could be sort of potentially hostile stance with the West, the big one he obviously points to is China, will begin to rethink where they're going to sort of keep their reserves in. Obviously, a lot of China's reserves right now are in U.S. treasuries. I think he said around 55%. I could be wrong on that. And there's not really anywhere else for them to put that cash. He first goes through storable commodities. So things like energy, food, and metals. And actually, China's already done that. China has one of the largest sort of supplies of storable commodities in the world. They're now actually using that to sort of get leverage in Africa by giving foodstuffs and things like that. But obviously there's huge storage costs with storable commodities. It's also just not practical to sort of keep that much in storable commodities. And so he then looks at gold. He thinks he actually also has gold going to $20,000 because he thinks countries will begin buying gold. But gold is just not nearly liquid enough, and particularly for smaller countries, the storage costs are quite high, and it's just not very feasible to transact in. So then finally, he sort of looks at BTC as that third kind of place that is going to absorb this liquidity, and in particular, he thinks for China. The easiest path for China is actually to unban Bitcoin mining. They wouldn't necessarily buy BTC outright. They would just essentially create a state-sponsored Bitcoin mining operation. And then on the sort of smaller sovereigns, so he looks at El Salvador. He thinks El Salvador would just straight up buy Bitcoin, which they actually have done. I believe they have about 1,800 BTC now. And what's actually interesting is he put this piece out yesterday, and then today, this one of the poorest countries in Africa, Central African Republic, just announced that they've legalized BTC as tender as well. So they're the second country after El Salvador. And he kind of calls one last thing. He calls it kind of a virus. So he says it spreads very slowly at the start. So you'll see a couple small countries here and there, and then eventually all countries will begin storing their reserves in BTC.
It's interesting because I totally get the argument that central banks should hold Bitcoin. And the whole experience with Russia and Ukraine, I think, speaks to that, because all of a sudden the Russian central bank realized that any asset that it thought it owned, which was someone else's liability, whether it's a bond or cash on deposit in some foreign financial institution, wasn't easily accessible. Now, I'm not saying this is great for countries like Russia or whatever. I'm just saying that there's actually an argument to be made that when you're looking at a basket of assets, that Bitcoin should be one of the sort of few that you actually hold as a central bank. And then the other argument that in a lot of parts of the world where people are overly reliant on the US dollar, like in El Salvador, where the country's actually dollarized, like they used the US dollar as their currency, there's nothing to lose by taking on Bitcoin. Where I'm skeptical of this argument is in the countries that have their own national currency that are trying to protect that currency's value and who are frankly like very reluctant to embrace Bitcoin. And I know this firsthand because I was on a panel with the governor of the Bank of Pakistan about 2 months ago, and his deputy basically just released a report saying that the country should ban all digital assets. And in the panel remarks, it was quite a thoughtful approach, or I should say, it was quite a thoughtful sort of take that he had. I think overall it was a bad idea, but what he said basically was, look, I mean, we don't want to end up on a watch list and get access or get cut off from the US banking system, and they're worried about terrorism financing. I think that's unfounded. But B, they're worried about a thing called dollarization, but with Bitcoin, where basically people in Pakistan start using Bitcoin so much that they stop using the local currency. And if you look at Pakistan right now, like the inflation rate is sky high. So people probably are looking for other ways to store value and to do commerce, right? So that, I just think there's actually a huge like middle ground of countries that are going to more likely be hostile to this than in support of it. But I still think it's an interesting idea for sure.
Yeah, no, I totally agree. I think a good model for this is South Korea, which has very stringent capital controls. And so something like BTC, on the face of it, is kind of sort of against those, against capital controls. Obviously, it allows you to sort of hold your capital bring your assets with you however you want. But interestingly enough, Korea has one of the biggest crypto ecosystems in the world. And the reason why is they have an incredibly, very highly regulated crypto ecosystem. So it might be one of those things where countries that have sort of competent regulatory mechanisms will be able to sort of embrace crypto while still having some sort of level of control over it. One thing I wanted to sort of without spending too much time on this, I was kind of curious about the recent news with Fidelity. Do you want to sort of jump in on that?
Yeah, so Fidelity, for those who are listening, probably many know, is one of the largest asset management and asset administrators in the world. I don't know what their current tally is, but it's like somewhere between $5 and $10 trillion of assets, either under management or custody or under administration. So it's a massive company. They've been very supportive of crypto for a very long time. Their CEO, Abigail Johnson, who's the daughter of the founding family, has been mining Bitcoin, or was mining Bitcoin in her office in 2014. So she's like an OG. She's probably been in crypto longer than most people. And they've been really deliberative in their approach to developing crypto and Bitcoin sort of solutions. And they even have a digital asset group run by a guy I know personally that have done some good stuff. Anyway, they're in the news today, or I guess yesterday, because they've announced that 20,000 retirement plans in the US, what are called 401ks, will now be eligible for buying crypto assets through Fidelity. And that's obviously a huge step. It could unlock, untold millions of individual self-directed accounts to buy into crypto. But what was reported, but I don't think properly sort of explained enough, is that these are groups that have to opt into that. And so if you're a plan administrator and you're worried about whatever blowback or uncertainty or fear about a new asset class, then you can just say no, right? It's not like just because Fidelity offers it that everyone has to accept. And according to a source that I have in Washington, D.C., who's a fairly high-profile lobbyist, there's some concern that the Department of Labor's rules and regulations around this might actually stifle how many of these plan administrators will adopt Bitcoin. So it reminds me sometimes of these, if you build it, they will come. It's like, yeah, but there need to be pipes, built to connect into these kinds of things. And if there aren't, then it's not necessarily going to be a slam dunk, for example. So I thought that was sort of interesting. And then there was another related headline. Well, I don't know about related, but just another thing about mainstream traditional finance, which is that apparently, according to Bloomberg, all these Wall Street banks are waking up to the potential of Bitcoin and crypto, and are starting to begin to offer products and services to clients. What I find really interesting is that for a long period of time, everyone got really, really excited about when a big financial institution or like audit firm or consulting company said anything about blockchain or crypto or whatever. But today, these companies don't really need Wall Street. Like the industry doesn't need Wall Street in order to be successful. I do think that it is important that this technology become more integrated into the financial system. But if you look at the size of these businesses, Binance as a company probably is more profitable than any of the big investment banks, save for maybe JP Morgan. I mean, like some of these exchanges, FTX, a private market investment, just got valued in the private market at like 25 or $26 billion. I mean, that puts it, in the same ballpark as a lot of like massive financial institutions, like the NASDAQ, for example. So there's all these reasons to think like, actually, instead of needing Wall Street to co-opt this technology or use this technology in order for it to scale, maybe a lot of these institutions will simply leapfrog it. And today, what's happening in Bahamas is FTX is hosting its big conference. And that's an exchange that's founded by a guy known as SBF, Sam Bankman-Fried, who started on Wall Street, kind of like Arthur Hayes, and is like, look, we're just going to build like competing financial infrastructure for not just crypto, but for derivatives and for, maybe equities and bonds and who knows what else. And so I think that there's actually a possibility that, crypto is not getting co-opted by Wall Street. It's actually eating Wall Street. And that's something that, you've got to be quite interested by. And so it's all of a sudden not like, what can we do to stay ahead of the curve and so that we can look like we're being innovative? It's like, what can we do to prevent ourselves from being consumed? Now, I think that's maybe overstating it, but I think like there's now a legitimate risk. These massively well-capitalized companies who are benefiting from a huge flight of talent out of Wall Street into these firms actually have an opportunity to, start to chomp away at big sections of the businesses of traditional incumbent firms, which is quite interesting.
Yeah, no, I totally agree. SBF recently said, I think he was saying in response to someone about buying it or working with Goldman Sachs, he was like, oh, maybe I'll just buy it one day. And I know that SBF is actually working with the CFTC now. So they actually put a proposal to change a rule in sort of how the CFTC regulates derivatives exchanges so that they can use FTX's technology for traditional commodities and things like that.
I saw that. I'm not smart enough to know, but basically it was like, we're going to go to an algorithmic settlement system versus like, I don't know what, open outcry. I don't even know what they use, but it's like, sort of like, I think there were some old timers who were like, whoa, slow down. So that's sort of interesting.
Yeah, exactly. I mean, one other thing too is like the crypto firms are going to have a much, much lower cost of capital. And what I mean by that is they like things like FTX are going to trade at a much higher multiple versus something like a traditional bank. So at a certain point, it actually does make sense in some ways to, if I was one of these sort of crypto derivatives exchanges, and I'm looking to break into sort of traditional Wall Street, just sort of buy out some of these lower multiple financial institutions.
Sure. I mean, it would be like a hugely accretive deal.
Accretive, yeah, exactly.
If you were to do that, like if you're trading at 100 times earnings and you buy something for 10 times earnings, then you're going to add more than 10% of earnings per share if you stay at 100 times earnings.
Yeah, exactly.
Basically, so sometimes that works, sometimes it doesn't. Another example of that in another industry is actually like in automobiles, where Tesla has got a market cap between 800 billion and $1 trillion, depending on the day. It's 3 times as big as Toyota, the next biggest competitor. And whether that's justified or not, it has meant that at times Tesla's been able to tap into like equity and debt markets and raise ungodly amounts of money. And by doing that, has been able to build huge state-of-the-art factories, which can now produce automobiles at a faster clip, better quality than other competitors. So, those windows are not always open. We don't know, like Tesla and a lot of growth stocks are taking quite a beating right now. It's possible that, the wind comes out of the sails of valuations for private crypto companies, but at least for now, it seems like they've got the upper hand. And every day there's an announcement of another billion-dollar crypto fund, which is, injecting more and more cash into these companies. So I think that within the context of a local slowdown in markets, there's still this secular bull market in these companies and them taking share and getting bigger, basically.
Yeah, 100%.
Speaking of DeFi, crypto, and Wall Street, and how this technology and this asset class grows, we actually have a perfect guest who's on the show today, Max Galash, who will be speaking a little bit about his company, Coinchange. And it looks like Max has just joined us. Max, are you there?
Yeah, I'm here. Hi, guys. Thanks for having me.
Sure. Yeah, no, it's our pleasure. It's our pleasure. So we had a great call with Max the other day. He told us a lot about his company, Coinchange, and I was like, man, we have to have you on the show. So Coinchange is a fintech company providing what I would describe basically as simple and frictionless access to DeFi for institutional and retail investors. Coinchange currently has a number of institutional clients that are using their services for treasury management, and has ambitious plans to roll that out to other kinds of customers and markets. So Max, thanks for coming on the show. Why don't you start just by telling us a little bit about yourself and the origins of Coinchange? It's quite an interesting story.
Thanks for having me, guys. In the first place, I mean, I'm really a fan of your show, so followed it since the very beginning. I think you improved quite a lot, and I think that's in a good trajectory to be on the top 10, podcasts, right? Very, very soon. So DeFi is something that's still very nascent, and a lot of people have a lot of questions. So I would assume this topic would be of the interest for a long while. So would be my pleasure to be on as a guest, right? And to add value in any way we can, right? Because we have our own research team. We do quite a bit of a analysis on the market. We do quite a bit of a analysis of different features and yield opportunities within that market as well. So any partnership or participation is always welcome. Well, we'll do our best. So in terms of the points,
before you jump in, I just want to say thank you for being a listener of the show since the very beginning. I think maybe you and my mom were the only people every single episode. Maybe AY's mom too. She's like, but
yeah, I hope Andrew's mom as well was part of the crew.
It puts you in rare company, So anyway, sorry, go ahead.
Listen, so I would say, listen, any business has a story, right? Any founder has a background. Nothing is uphill, right? And or downhill. It's always up and down. I mean, the markets and the businesses and the startups specifically are a hard undertaking. I believe that the startups and the entrepreneurs, they're actually pillars of the economy, right? And that's how the innovation moves ahead. That's why we say we are taking Wall Street to the Mainstreet. We're not really against the investment banks. We are challenging the status quo, right? So we don't have to be against something to change something. So with Coinchange, one of our slogans is "Be the change" or "Time to change." That's Coinchange, right? So we believe there is a time to change and provide access to, let's say, call it wealth management for customers who never had that access before. And there are multiple ways to do that. I mean, right now, specifically with the DeFi, right, the ecosystem that kind of breaks the barriers, we believe that being a regulated, a compliant way to access primarily yields, so we can call it a passive income or yields daily in that ecosystem in a risk-adjusted manner would be only growing as a demand side on the retail and institutional side. So from my personal background, listen, I'm a computer engineer and I'm a computer electrical engineer from U of T, graduated in 2011, ran a small venture fund, had a professional services agency that's still around, sitting on the board right now, not really operational. Got a startup bug when I was managing small fund. So it was a 10 million fund called BGS. ventures. So investing in businesses, working with the founders got me excited, and never wanted to go back to the professional services world and work with the corporates and building their backend apps. So I wanted to be on the forefront, and started trying to spin off multiple startups within the ITM business. ITM was a professional services firm. So a bunch of them failed. One of them was successful, eventually acquired. So this is kind of fifth startup, and I think this is the most mature and successful so far. We have about 75 people on the team. We have 120,000 registered customers. We've raised about $5 million last year. So we're growing fast on the AUM side. So product offering is also expanding. So I believe that's the timing. The timing is right. The market is right. The product market fit continuously evolving. So I believe I believe we're going to strike it big this time. But it's always, you have to have talent at every position. It's not as easy as it sounds. I mean, there's always days you cry, days you smile. So you have to have resistance, right? You have to be nimble and humble. So, but DeFi itself, the big believer in the DeFi, because when we started the business, we looked at it, it was about $150 million, and 2019, that's when we started developing the platform. Summer 2019, it was really, really tiny TVL. So when we did analysis, we were kind of betting on the market. The market is going to grow. We can grow with the market, even though we might not be the leader or the best product, will grow with the market. So that was the belief originally. And the second belief that we bet on was that the market is going to get regulated and compliant, because when the market grows, everybody wants to have their, especially government, wants to have their fingers, right, tipped in. So we knew that it's going to get regulated and compliant if the first assumption will be true. So the market is going to grow. So we did emphasis on those 2 points. So first of all, technology, to actually have a competitive advantage and being able to provide a cross-chain yield. So we did big emphasis on technology, and secondary emphasis was more on the regulatory and compliance, because we thought it's going to be very important. So, but I won't, like, innovation and regulation doesn't go hand in hand, right? Usually it's kind of opposite directions, like more regulation, less innovation. But we try to strike a balance here, and working on both angles.
Yeah, so I want to talk about that. A couple of things you mentioned. One is, DeFi. Ethan Buckman, who's a previous guest on our show, he's the creator of Cosmos, which is like one of the most important blockchain ecosystems in the world, said that decentralized finance could also stand for democratized finance, meaning that you don't need to have access to banks and other institutions to access this world. On the other hand, and that's true in theory, but on the other hand, it's actually quite complicated to do a lot of the things in DeFi that are so interesting, right? Even the terminology, I think, confuses and bewilders a lot of people. Like the words, combining the words yield and farming together, honestly, when I first heard it, I was like, what on earth does that even mean? Like, and I spent my whole career in financial services. So I think that there's a steep learning curve. And what I find really interesting about Coinchange is that it's almost helping to bridge the gap, right? So there are all these ways, because this is a nascent market, there are opportunities to earn returns on investments in crypto assets that maybe could be better in the long haul than traditional financial assets. How do you make sure that you give exposure to people? And how do you make sure that it's not just like, industry insiders in crypto, and then later on hedge funds and other Wall Street people who are actually taking advantage of that? So it sounds like that was the sort of operating principle of your business. Yeah. So how easy is it for someone to do this on Coinchange, and can anybody access it, or it's only available in the US or Canada? Just talk a little bit about the business.
So let me touch upon the first point. You mentioned that DeFi is hard, right? And it's misunderstood by majority of the public. I mean, I think DeFi is like a trailblazer in crypto. A lot of people even don't understand crypto today. Like USDC, USD coin, USD stablecoin by Circle. For us, it's like, a term that everybody knows inside out. But when you ask anybody on the street right now, I live in the Bell Mills in Lawrence, I can go outside and ask anybody. They'll know nothing about what is USDC, not even talking about the USDT or DAI or any other acronyms. So there's a lot of education. There's a lot of acronyms that general public don't know and probably won't know for a while. I don't believe that DeFi is going to take over the world. I believe that DeFi has its own stance, and it's going to have its own portion and proportion of the overall financial markets. And we are lucky if we're going to get 5%, of the general worldwide financial markets. So right now it's really $150, $170 billion, I guess. As you were guys talking about Tesla, I think it's like less than 10% of the Tesla valuation, right? So total DeFi market. So we're still very nascent, we're still very early, and I won't expect a mass adoption. And any USD treasuries or any USD related investments funnel through to the DeFi pools. But I agree with the democratization for sure. There is a big one, not only democratization of access, but also democratization of value. So anybody, let's say right now in Africa or China, who has a good skills on Solidity and understanding of the math can develop an application, right? And has access to a global capital, has access to a global user base. And if there's a good incentives and economics built into the protocol, money will flow, right? Because it's a very high velocity environment. And it gives not only opportunities for customers to earn, but also for engineers and people who never had access, right? And ability. Apple Store did one layer of that access, centralized distribution, global distribution of the talent applications. All right. So the second right now, there's a fully decentralized basis with a way higher velocity, because in Apple you have to wait 30 days to get paid, as an example, right? And a lot of people have those clear bank business models to help them grow. In DeFi, you don't have that. The money is on the chain, the velocity is very high, and the access is unlimited. So not only from the retail perspective or user perspective, but also from the developer perspective and the engineer's perspective. So people will get more access to earn. So there is the democratization component from both sides, and definitely, if we talk about our business model, we are trying to make it, to your Alex point, accessible not only to people who are in the industry right now or have access to MetaMask or know how to use those tools and ready to mitigate their keys and risks, but also to the general public. And it's as easy as taking a selfie to register on Coinchange. It's available in Canada, available in the US. It's available worldwide except the sanctioned countries, right? And some, like in the US, we're only operating in 27 states, I think, where we get the authorizations. But we do offer the service for a novice crypto user who wants to be exposed to the DeFi markets with a professional oversight and without the day-to-day management.
Yeah, no, and I actually started going through the registration process, and I have to say the user interface is really, really awesome, super easy to use.
Thanks.
The question I had was, I'm kind of curious, how does it work on the back end? So where are these yields coming from? Is it all coming from one blockchain like Ethereum, or is it spread across multiple different chains? Can you just talk a little bit about sort of, because I remember we talked about the system sounded quite sophisticated, so I'm definitely keen to hear about it.
So, and to the model, right? So Alex mentioned democratization. We always say quite often taking Wall Street to the Mainstreet, right? So let a little guy earn. So to make possible to earn daily compounding, no lockup and no minimum yield, you have to have a pretty sophisticated infrastructure to be able to deploy those assets, redeploy those assets, reconcile them, and pay them out. So not only the centralized application of wallet management, account management, compliance management, core application, reporting and accounting, but also the core of the product, that's yield farming, that's aggregated yield farming across 5 blockchains today. So we have Polygon, we have Terra, Anchor, Binance, and Ethereum, obviously. We participate in about 15 protocols. So protocol meaning Uniswap, PancakeSwap, Aave, Compound, Curve, and so forth. And on those protocols, we participate at least a couple of pools. So it's about 30 to 40 pools right now, overall, where the liquidity is spread, right? So meaning the liquidity is spread, there is a wallet. So all our mathematics algorithms, I would say, right? So it's not done by me. It's not Andrew, it's not me, not Alex, who's pushing the liquidity in and out. It's all done on the algorithmic basis. So there's a universal execution that lives on top of those 5 blockchains. And there is certain computations that are done off the chain on the server that send a signal to a proxy smart contract that we developed to execute a certain command on a certain protocol, right? And there's a certain wallet that manages that liquidity in that protocol. So that's pretty much the platform, but overall it consists of three pillars. So first of all, it's data. So we have our own nodes that we operate, and we read historical and real-time data. So that data is used to take a decision in the strategy. So the second component is strategies, and this is our quant team who develops them. Strategies meaning that a certain mechanics on the protocol that will generate yield, right? And it might be a combination of a few. So as an example, providing liquidity, take an LP token and then lend it on another blockchain, on Aave, let's say as an example. So the third, what's important is third component that's important is our blockchain team, our Solidity team develops those proxy smart contracts that would take those instructions from the strategy and execute them on that protocol. And then also utilizing the existing bridges, let's say like our ARC, Celsius X, Wormhole, the others, to move liquidity between the blockchains or mint and burn across multiple blockchains.
Yeah, no, that makes sense. And I think one more question actually I had was, one of the things that was really interesting to me was that the stablecoin yield was actually the same for multiple different stablecoins.
Exactly.
So USDC, UST. I was really curious to hear sort of how that works. Don't have to go too technical, but yeah. I think that's a really great value prop for people, that they can just put any stablecoin in and get the same. I think it was about 12.9% yield.
Yes. Yeah, exactly. So the yields are around 13 to 14% APY, right, for the customer, annualized. And the stable coins right now, what happens is when you put your stable coin as USDC, it actually splits on the different stable coins across different decentralized applications and pools. So let's say DAI UST pool, DAI USDC pool, USDT USDC pool, right? And that happens and managed with the same strategies, just on the different protocols, because Uniswap is pretty much a copycat of PancakeSwap with improvements, right, to the certain economics and mechanics. So it's managed by the same strategies and managed by within different pools and protocols. So it will generate the same APY and will be exposed to the same risk. So it's exactly the same product. While Ethereum or Bitcoin utilizes different mechanics and different protocols. Alex, you're on mute.
One of the things I find really interesting about this is the returns themselves. So, if you look at the gross returns in DeFi, even on stable coins, they are quite high. But if you go to like Coinbase or to Binance or one of these other things, and you're staking, let's say you got a proof of stake token or something, like you're going to earn significantly less than what like the gross yield would be if you had done it yourself. And that's because like the exchange is taking a big cut of the action. Now, it's not unreasonable for a business to provide a service and then take a fee, but yours seems so much higher than everybody else's. How is that possible?
So I would touch upon the yield itself. So the way today the yield is generated on the market overall in crypto is in three ways. So first of all, the one that you mentioned is staking. So proof of stake, right? Validating the transactions, right? Everybody knows Ethereum is going to have a merge in summer, hopefully, and completely be a proof of stake blockchain. So people are getting paid and they're locked up for a certain period of time when they provide their coins to validate the transactions. That's a layer one yield, layer one. So as an example, Block Daemon or Figment, those businesses operate their own nodes and they provide proof of stake infrastructure for their clients. So the second ability to generate yield is lending. So that's been around for last 3-4 years. The businesses like BlockFi, Celsius, Nexo, they all operate within the lending environment. So when they borrow from the retail or the other customers and lend it to counterparties like Galaxy, Genesis, and so forth, and they take a cut pretty much right from whatever they paid and whatever they distribute back to their customers. And there's multiple levels of risks as well associated, right, with the counterparty risk, third-party custody, re-engineering of the contract, right, to resell to the end consumer. And the most recent one is pretty much what we do, is like a layer 2 yield, right? So yield for providing liquidity to different pools, staking pools, lending pools, liquidity pools, to enable that infrastructure, to enable DeFi to exist, because that's the premise of this abstraction layer of this DeFi ecosystem, is liquidity. So it's not market making. We're not really changing the price of a bid and an ask. We're not really have any spread, because all the pricing is determined by the application. Let's say, as an example of Uniswap, the formula determines the price. But what those apps do, they pay you for the liquidity part of the fee that they generate. So if you do it smart across multiple blockchains, and if you combine LP, let's say, that was staking, LP was lending, you can boost it. So in our example, we can probably be better compared to than Coinbase. We're going to be better compared to, let's say, Yield App or Swissborg or Your Finance. Yeah. So I think that's a more fair comparison, even though we bid them on the APYs regardless, because majority of what we do is off the chain. So as an example, Your Finance has all their strategies off chain and different vaults. So this is more of a commoditized mechanical approach to generating yield, because any public knowledge is already not an IP, not a knowledge. So our strategies are all off chain. So some of them are more computationally intensive. So we're able to generate higher yield, as well as combining across 5 blockchains different products. So that's also part of the new nascent market, when different applications are ready to pay higher incentives to attract liquidity. So let's say Terra, right? Terra is an example, paying 25%, 24% of their short farming and lending. I don't think it's going to be a very sustainable yields that they will provide for forever. So there's probably going to be different ways they're trying to sustain that, but there's different models that be in favor or against. But I believe there's going to be more opportunities that are going to come to market. So that's a beauty.
That's a good question, isn't it? Because some people say, well, these returns in DeFi are temporary because it's a new and inefficient market, or it's a new and market where there's so much incentives being paid to LPs or to early adopters. But in the long run, in an efficient market, you shouldn't be able to earn this kind of return. And then the other point I wanted to make, which is that, people would say, well, you don't get something for nothing. So if you want to put your money in the bank, you can earn 0.5%. If you want to buy a T-bond, you can earn 3%, which is sort of like cash. But in this area, you can earn 10-15% on what is effectively a cash equivalent.
Yes, cash equivalent, yeah.
Right, so USDC or UST, these are stable coins that are pegged to the dollar, for those who are maybe not super familiar. So you're not like taking price risk in the way that you are when you buy into a pool where you have to pledge things that are volatile, which you might earn a yield, but you might also lose on the principal investment.
Exactly.
In which case you're no better off. So these are on things that this is returns on a cash equivalent.
Yeah, exactly.
So is the 10% or the not whatever it is, like the 9% delta between the yield you can earn on USDC in one of these pools or UST versus say buying the a T-bill or whatever, a treasury bond, is that just a reflection of protocol risk, counterparty risk, hacking risk, and all that other stuff, or is there really some alpha here? This isn't about your company. I just curious.
Yeah, more about the market. More about
the stablecoin space. It's kind of, and we actually talked about stablecoins in the last episode, so I think it'd be a good sort of segue.
Listen, Alex, I think it's a fair statement that you did originally. When the market matures, the yields decrease. I think that the yield is paid proportionally to the risk you take as well. So higher the risk, higher the yield, higher the alpha. I think that on the other side, more traditional banking system right now is pretty slow. So the velocity of money is low. So money exchanges less hands and creates less value. So because of the settlement networks, because of the SWIFT, because of a lot of outdated backbones of the banking system. So I believe the true value of a dollar is higher than the bank is paying. So probably digital representation like USDC in the digital economy will give you a more true value of a dollar. But it's definitely not 25%. I would say and assume, I don't know if we run any models, but from the general understanding, it's higher than inflation. So it's about 9 to 10%, the real value of the dollar. So based on that, I would say that in the efficiency that exists in DeFi, right, because of the less friction and the speed of the capital to be allocated to a higher earning and more effective opportunity, everything should be risk adjusted. But I believe that the yields around the ones that you were naming, about 9-10%, I think that's a fair value to get for. What happens when markets mature? I believe that that happened with the arbitrage opportunities in CeFi world, right? So crypto CeFi world, I mean, everybody read the stories, right? So you can buy in Hong Kong and sell in Chicago and get a couple of points on the arbitrage of the same asset is not existent right now. The markets, the spreads are very tight. The markets are very professional. The speeds are very high. The HFT players like Alameda, and I think right now Citadel making the markets. So DeFi is not touched by the big institutional players right now, regulatory and compliance wise. They're not able to participate. I would say that DeFi will, and right now definitely, but also will be evolving at a pretty fast pace. So a lot of traditional financial instruments or financial services, like insurance, like payments, like derivatives, will be migrating to the DeFi markets. So meaning that there will be new opportunities to provide and earn. I believe because of the geopolitics and a lot of uncertainty in the banking system around the world, people will be migrating to your own keys, your own crypto, to DeFi. So there's going to be more users, more activity, more fees. So probably the market is sustainable. Probably the yields are going to be around those numbers, around those ranges that you mentioned. And I think that until nobody knows what future holds, but on the macroeconomics level right now, it seems like this is where the true value of a dollar is. And it's accessible for the retail customers on their own, whoever can quantify and understand the risk. And majority of the risk here is a cyber. I won't, first of all, you can forget your own keys, right? I'll lose your passphrase and then never recover your assets. That's kind of a basic risk. I think everybody should understand that. But number two is any pool or protocol can get hacked. It's just a matter of your ability to quantify, to do a proper process, underwrite that risk. So that's part of our business. Like, we underwrite and quantify the risk on the protocols we connect to, and we maximize the yield on risk-adjusted basis.
Fascinating. I mean, there's so much more to discuss. I'm just, in the interest of time, I want to get in one more question, which is that we're talking a lot about, Mainstreet investors who find the obstacles for DeFi overwhelming, but you're creating a solution. And now you can earn return on cash that is higher than what you could through a normal financial institution. It's a pretty appealing prospect, and it's simple to understand, right? And you're helping to sort of simplify or maybe even obfuscate, a lot of the complexity that's happening. But we haven't talked much about institutions, and I'm not talking about, hedge funds and Wall Street banks. I'm talking about, holders of cash. So people have a lot of cash, companies and institutions have a lot of cash, and you found a lot of success with some treasury management, basically,
yes,
in the crypto space. Can you talk about that a little bit?
Yeah, so we started offering the retail product last August. So since then, we onboarded 60,000 KYC customers to the platform, and we decided to try it. So it was natural process when when the customers started asking you, they can fund the accounts through their own corporate banking. So we created an onboarding process for their corporate clients, and we upgraded those customers to corporate just to allow them to pay taxes as a corporation on that yield file as a corporate tax, and then being able to fund the account in USD through their corporate bank account. So just as of recently, as of February, it became more of a product that we started to offer. So as a treasury management product, and primarily to the crypto native businesses, so like crypto miners, crypto consultants, NFT marketplaces, play to earn businesses, gaming. So we have more than 20 businesses right now that run their treasury on our platform, and collectively they have north of 30 million on the platform with a minimum deposit, I would say $250,000, with the largest one close to 10 million. The beauty of that is there is no lockup, right? So all the funds and all the assets are always available on the chain. So if tomorrow all our customers are going to request to withdraw their funds all at once, all the funds are available. So because there is no market positions, there is no lending, there is no replication, all the assets are provided across different tools and protocols, right? So they're always on the chain. So that's very easy proposition because there is no lockup. The funds are available within 24 hours because the deployments are happening on the aggregated basis. So we found it as an easy sell, but we went to the more traditional USD based businesses that run their treasury on the banks and money markets, and that didn't resonate well because it's still really hard to grasp the concept of how the yield is generated for those businesses. While the crypto native companies, they understand and know DeFi, they know how is that yield possible. Right, the others would question even if it's sustainable, or you're paying out for the new deposits to the older customers, right, as a scam. So that's how it might look for the traditional business that used to get 2% of their cash, right? So the crypto businesses do actually understand the yield and do they understand the risk, and we've seen a really good adoption from the treasury management. Right now, we're also improving the product because before the retail interface of the product was the same as the corporate interface. Right now, we're adding multi-access as a big one, right? So customers on the corporate side can provide access to their CFO, treasury manager, financial director at a different level to a different feature. So as an example, requesting the reporting can be done by the CFO, but checking the account activity can be done by the financial director. So we started evolving that product. Right, it was the same, but right now the product is actually changing because we see there's a lot of demand on the market for this kind of offering.
Yeah, fascinating. Well, I mean, there's lots of, I'm just thinking even within the crypto world, there's so many foundations, so many companies that, I mean, if you go to, I think bitcointreasuries.com or Dow Treasuries, you can get a sense of the tens of billions of dollars of assets that are held by, crypto native companies, to say nothing of more mainstream. So yeah. I think you've got like quite a, it's a lot of greenfield opportunity, Max, with the institutional, with the retail. I think that the idea of like creating something simple and easy to use is obviously always a smart idea. Steve Jobs got that right with the iPhone. So and every other thing that Apple's ever done, and sometimes, there's a lot of the do-it-yourselfer community in DeFi is sort of like that, that homebrew computer club or whatever of the early PC age. But like eventually to make something a mainstream product, you got to turn it into a toaster. So maybe you're creating the toaster for DeFi. All right, that's it for today. Thanks for joining me, Max.
Thanks,
look
Alex.
forward to having you on again when you've got more to report on how things are going. But that was a great episode. Really learned a lot. So thanks for joining.
I appreciate it for having me. Thanks a lot.
Thanks.
Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.